Viewers, investors, and traders, it's another Monday morning roundtable. And today I'm joined by Zeph Zaninieri, Roger Scott, and a surprise guest a little later on. Gentlemen, welcome.
Thanks for having us, James.
Thanks for having us, James.
You bet. So we start off this last day of summer with near zero temperatures in Canada across the country, but also with the plummeting Dow. And so with all that's going on, Jeff, what's the driver of the weakness in the market or the corrective force?
So there's two things that have occurred overnight that are big news drivers. So the first one is there's a bank scandal with some European banks and Asian banks like Hong Kong, HSBC, and Deutsche Bank. Deutsche Bank is the biggest culprit of this. They've been money laundering. Now, everybody that's in finance knows how the world of the ultra high net worth wealth management works. It's a big tax, hide it from the tax man game that's played. But the numbers that came out were staggering. It was $2 trillion of money laundering between a handful of consortium of European and Asian banks. So far, the US banks aren't implicated in this, but Deutsche Bank down 7 or 8%. HSBC is at 1995 lows, 1995 levels. Okay,
we've been talking about
those banks. These are banks we're short. Roger and I have been shorting those kind of stocks, and so that's a segue. Like one thing a big thing we've been talking about is hedging by sector rotation. Well, the airlines are down double digits today. Financials are taking it a little bit harsh. Small caps are harsh. You can only really hedge by being short. The second news story that I wanted to get to that moved things a little bit this morning is that they might have to go back into lockdown in Europe. So this is another theme that we've been covering for weeks, all of us. It's not going to be like a silver bullet magic like reopening, right? There's a bumpiness to this that's happening with COVID. And you're seeing today pockets of strength in technology again. The stay-at-home names are getting a bid again, and the stocks that like the airlines that were counting on this just smooth trajectory back into normalcy are getting hit because that doesn't look to be the case.
Yeah, you bet. Roger, is that consistent with your thinking?
Well, in addition to everything, Jeff, I honestly didn't know anything about the scandal till you told me about it.
I'm short Deutsche Bank, so when you have a position on in something and you get one of those, I'm so used to having these bad news the past couple of weeks. When I had a good news come up at 3:00 in the morning on my iPhone, I was like, "Holy crap!"
Yeah, and I've been recommending shorting HSBC, as you know, and the Spanish banks as well. We've talked about that several times. The only thing I want to add to what Jeff said actually is increased tension between Trump and China. There's that as well. We've seen quite a bit of that last week, and it looks like it's picking up right now again. So it looks like we're It looks like that tension is starting to rear its ugly head, and that hasn't been good for the market whenever it's happened.
So the banks are definitely taking it on the chin. COVID-19 situation is definitely accelerating back into state of emergency territory in Europe, and one would think by extension the rest of the world, though the rest of the world is clinging through preference to its delusional reality that it would prefer to exist. But we're seeing that, airlines are certainly not going to be able to live in the alternative reality just because they wish the coronavirus would go away. And so what is now has your expectation as to the direction and impetus of all of the COVID-19 related economical there was a rebound, now the rebound's fading, the economic indicator, the weekly economic indicator by the Fed is now starting to point more steeply downward. Does this mean we should be bracing for more of a tsunami now that flu season is almost upon us?
Well, I think let me take apart your question a little bit. In terms of the COVID stocks, I think the COVID stocks are priced in. I think everything that's valued into COVID stocks, as we know, because there's not much going on. We're kind of sitting and waiting for these 2 or 3 drugs to come out, and all the hype and all the puff and all the we're going to do this. That's priced into those stocks. As far as technology, I think we're going to see more of a, I think the market on a technical basis was overbought. And I think it has a bit more to go. I think we're going to shake out a bit more. I think we're going to go under the 200-day moving average. We need a shakeout. If you looked at stocks in the NASDAQ 100 trading above the 200-day and the 50-day moving average, they were historically overbought up to about a week ago, about 2 weeks ago. So this would be a good time to have that shakeout and have the weak hands come out. I don't think the market's getting ready for to pick a top. I don't think it's anything like this. I think it's a classic shakeout that was much, much overdue. And we're going to see a different class of stocks, a more broader class of stocks lead the market. I think we're going to see more industrial, more material. I think we're going to see consumer staples. I think real economy, I think it's time for the real economy to start showing its face back. So I don't think it's going to be the same type of market that we saw unless the bounce is really, really hard and really, really bad. In other words, and the only reason I would see that coming is if COVID starts coming back into the US and we start going back into the emergency mode, and that we're not there. We're nowhere near there right now. I mean, we've got Europe, but this is not Europe. This is America. So unless America starts to go into panic mode, and I don't think that's going to happen because much of the fear and the downside was already priced into this market. We've seen that in February. So in my opinion, this is a very classic market correction. I think we need to take the market a little bit lower before we go back higher. We've been predicting this, anticipating this, and telling all of our subscribers this was going to happen, telling people to lower their position, get into ETFs, get into short positions, getting into stocks that have been historically weak, recent historically weak, like airline stocks, into bank stocks, and just lowering their exposure overall. So this is not unexpected. This is not something that's surprising by any stretch of the imagination. I think this is very, very healthy, and I think the market needs this in order to propel forward.
Mm-hmm. Okay, Jeff Yasteen joins us now. Jeff, how are you doing today?
I'm doing okay. I'm doing well.
Great. I guess since you've been commuting for the last hour, you haven't had an eyeball in the market, but looks like a corrective phase has entered the main indices. So, Jeff, what are you thinking about this ratcheting up of the coronavirus sort of fears again, now that flu season's upon us and infection rates are rising, alongside the weakness in airlines and also a bit of a rebound in the COVID stocks? How's that impacting your thinking for the week?
For the week, actually, I'm starting to lean towards the bullish side. You know, we saw this, this with the Fed meeting last week. We saw how the market rallied up. We had the Fed decision on, what was that, Wednesday afternoon, and then the sell-off began. I get the sense that we're close to some sort of, I won't say a bottom for the next 3 months, but a short-term bounce of some kind that is going to be enough to kind of keep all the bears, myself among them, off balance. I was covering some of my personal short positions Friday afternoon. I wish I'd kept some of them for today. But I feel like we're getting close to some sort of a bounce to the upside. I do feel like Roger was just saying, though, that there probably is more downside, a week or two on into, let's say, mid-October. And just like Roger was saying, at this point, I would view this as a classic correction. I'm just echoing what he said because I agree with it 100%. Mm-hmm. The markets were all, S&P and the NASDAQ were all heavily overbought. They're so fully weighted or overweighted with those key tech stocks at this point. So, this pullback shouldn't be anything of a surprise. All of us have been talking about it for a while now. And this is the chance, say a few weeks ago, is more of a chance to rotate out of those. And you still have that shot now and get into some of these positions, industrials. I know what you're saying, the concerns about COVID and all that. I still feel like you should be buying like retailers here. I feel like we're in the backside of this pandemic. I guess I just don't sense that the threat from COVID in the winter is going to be quite as bad, simply because the controversy over wearing masks or not wearing masks aside, I think most people know the right thing to do and all that. And I feel like that's going to probably keep the worst case scenarios on COVID out, off the picture. And because of that, I feel like generally you can still have a somewhat positive outcome, especially once we get past the election. That's the other key element. I know you haven't asked about it yet.
Sure. Okay. So if the infection rate continues to increase, and I mean, fair enough that there's a sentiment that's out there that's obviously valid that we're on the back of the pandemic, but potentially we are just going into the worst second wave of the pandemic. And so if that were to be the case, if the pandemic were to intensify to beyond where it was when it first really got a head of steam up in March, I'm wondering, is it advisable for an investor to consider positioning themselves to catch all of the great things that happen when the government starts to print money and the economy goes on lockdown again? I mean, is that something that we should maybe be having at least a contingency plan for? And I'll start with you, Jeff, on that. Are you making any kind of contingency for that?
Which Jeff?
At this point, I've been so focused on retailers. I've been positioned in the other direction, basically. Retailers, airlines, cruise lines, and like I said, some of those have been giving up their gains and have been fading, obviously. The thing about that, I agree with it, but a lot of the most obvious plays, copper and especially in the commodities markets, those have already run. So you're basically going to have to just buy high and hope to be able to sell higher. You're not going to get I don't think you're going to get a second chance to get in, except to just buy and ride it and make sure you're okay through the pullbacks. So I agree with the scenario. I'm just personally, I'm not positioned for it yet.
Mm-hmm. Jeff Z, are you making any moves towards a contingency plan in the event of government largesse raining down hard upon us to counter an intensification of COVID?
Here's the thing. I agree with Roger with the whole with the worst of COVID's bite being behind us. What I don't necessarily have a constructive or optimistic view of is the economy rebounding back to normalcy. So that's to say, when COVID first hit Western nations in March, we thought it had a 5 to 8% mortality rate. We now know that's not the case, right? So when you take out that severe panic option, I think that lockdown like we had is going to be a hard thing to sell on the public. I mean, you're seeing in Europe that they're trying to enforce this lockdown. They have homogenous populations and they're generally in line with a lot of the things. But I know that in the USA, that's going to be a tough one to sell. That's going to be a tough one to sell. How am I preparing for the worst? You have to, I'm a trader. A lot of times we have conversations here, and I think we get our wires crossed because some people are talking about longer term investing. Some people are talking about owning stocks for a couple of years. I'm looking at a couple of weeks to a couple of months time horizon. I don't see how you can have much clarity past November in the US. It's going to be, and I know over the long run, you can get, you're going to get back into its groove, but you're going to have months and months and months of rockiness. What I'm looking at as the telltale of the tape are those oversold tech stocks. We do have a double-digit September sell-off. We have Apple down over 20%, the NASDAQ down over 10%. If you're going to see real buying, it's going to start there first. You're going to know the bottom's in when you're going to see those stocks rallying. I've seen a couple of these stocks rallying today, but the weakness in energy, the weakness in financials, and the weakness in airlines and those companies it's too much for the tech bounce to counterbalance today. I just feel like it's too much of a tide today. But you're going to know the bottom's in, not when American Airlines is rallying in the next couple of days. It's when you see Amazon and Apple rallying, in my opinion.
Mm-hmm. Roger, you're nodding in agreement. I see over there.
I completely agree with Jeff Z. in terms of what he just said. My time frame right now, in light of what you said, my time frame right now is very short. I'm not looking at what will happen if the COVID. Right now, I'm looking at retail sales numbers that are coming out this week. Right now, I'm looking to see if my Trump-sensitive stocks are going to lead or Biden-sensitive stocks are going to lead. This is not the kind of market where you can extrapolate and look 3 or 4 steps ahead. If we were to do that, we would really be in deep doo-doo over the last several months. This is the market where we want to stay in the now, in the right now, and maybe a week or two ahead. Going too far into the future can be very, very dangerous right now. Very, very, because the market is being driven by because there's so much happening now. You see, when the markets are doing their typical rhythm and there's nothing crazy going on, like COVID, like the presidential election, like numbers that are, best numbers in 20 years, worst numbers in 20 years. When you don't have the craziness that we're seeing right now in the world, and everybody would agree that there's a lot of craziness going on in the world right now, especially economically. That you really can't extrapolate too much in advance. This is a trader's market, and I think that's how we have to look at it. That's the only way I've been able to kind of stay on top of it, or at least one step ahead of it. We called basic material stocks and FedEx to go up 3 months ago because of how I was seeing the surprising numbers I was seeing out of retail sales that were not expected. And like this week, we have 2 retail sales reports that are very, very important. And we have some housing data. So I think right now, the key is not to extrapolate too much going forward. I think that's really the main advantage we have right now over the typical time, where we can usually go a little bit ahead, but it's hard to do that right now. I mean, I've been doing this for over 26 years. It's almost impossible to do that right now. I think we have to stay in the now, and we have to react based on the info that the market is giving us today.
Sure. Okay. Interestingly, it's interesting that you guys are traders, and I am definitely a long horizon investor, first and foremost, to the point where, it's like, I love this. I get to disagree with you vehemently about looking into the future. I mean, for me, and respectfully, I appreciate the trader mentality in that you're interpreting the right now to make money right now. And that's obviously, that's great. I've sort of adopted the longer term horizon more so because I view the future as a increasingly challenging place to survive. And I mean that existentially, not just financially, but we are going into, if you look at the longer term indicators of the convergence between consumption and resource production, those lines have crossed. And so we're at a point where, much like the analogy we like to discuss in the musical chairs, it's not that the music has stopped, it's just that the chairs are already disappearing before the music stops. And that is very much a part of that's part of the game. That's part of the marketing strategy in the retail investor financial product category. It's like, never mind the chairs disappearing, keep putting money in the market. And so that does induce a lot of sort of short-term trading behavior. I have gone all in on the long future, where I've moved to a farm. I'm starting to grow my own vegetables. I'm going to raise my own Wagyu beef. I'm putting in solar panels. I'm collecting rainwater. It's not doomsday yet.
You have a weapon. You're in Canada. I was going to ask if you had a weapon. That's the full kit, but that would make you American.
Well, see, in Canada, I can't admit whether or not I have a weapon. I might have a weapon or two stashed away. It wouldn't be an assault weapon because that's illegal. But no, so this is the big resolution to this long-winded preamble that I'm trying to get to is that, okay, great. Short-term trading is absolutely the way to, protect your financial health in the here and now. But I want to disagree with you. And I think this is a great platform for us because the trader is obviously short-term focused. The longer-term fundamentalist, misses out on all the short-term stuff because he's so busy gazing at his belly button into the future that, on the long enough timeline, the survival rate for everybody is 0. And with that in mind, that's why I gravitate towards not to steal a line from Zero Hedge there, but that's why I gravitate towards the longer term viewpoint. And so my next question is, in the short term trading mentality, do you not make any sort of contingency for the longer term outcome where, for example, let's say that the debasement of US currency was to continue apace when inflation was to explode to the point where we have a hyperinflationary event and the US dollar collapses. And this sounds outrageous, I know, given the current situation, but that is the longer term future upon which, a lot of my contingent banks, and that drives, things like gold and commodities and everything that's non-USD denominated. Do you have any contingency plan in mind for that, Jeff? Do you hedge your future at all against the short term by the possibility of a long-term catastrophic event, black swan?
I literally sat down, and I knew the market was not doing well when I got in the car. But I sat down here in the studio, and I see gold down. What is it down? Almost 3%. Bitcoin's down almost 4%. So you know what? If you're looking for a pullback, here's a pullback. I don't know if I'd buy it this exact moment, but somewhere in this downtrend that's been building, you would want to buy this stuff. And that's always the hard part for anybody, is buying the pullback. And knowing that the fundamental macro view, which I agree with, and usually it's those things, those extreme ends, like you were talking about, Jim, that where money printing and the concern about a hyperinflation, which is the probabilities, classic economists might say is 2%, 3%, 1%, and yet those are the ones that just do people in and change our society and change our fundamental financial health to the negative. So here's your opportunity to do something with that. And in fact, I'm going to be one of those people doing that, gold stocks, silver stocks, because frankly, I missed a lot of that in terms of new positions from earlier this year.
You bet. Jeff Z, what about you? Any contingency, any thoughts on that?
James, James, I want to cheer you up a little bit because you sound a little bit sad. Maybe it's the frost. I don't know what it is. But one of the beautiful things about being a trader is that to be effective as a trader, you have to remove yourself from that kind of zealotry. You can't have any sort of such a rigid worldview, because then you miss so many amazing moves up and down. My contingency plan is I trade short also. I buy puts, I short sell stock. I have bearish exposure to the market all the time, and real bearish exposure, not a bearish exposure like I need gold to go up or I need someone into these defensive stocks. I'm short things that go down a lot, and I'm long puts that go up a lot when VIX explodes. But what I do is I vary the ratio. What I'm trying to say is that if you get so stuck in this concept of this end game that we're going to get to, you could be right, but along the entire way, you're going to miss a tremendous amount of opportunities to pick cherries out of the ground, in my opinion, or pick them up off the ground. Because the thing is that even if you are right, you're going to get to the spot, then now what? And then you have to ask yourself, why do I feel the way that I feel? I mean, the evidence is there, right? The evidence is there, but it's not happening. It's not happening per se. There's still the other side of the coin. You could look at life and say, we're in the worst economy ever. The Fed is so fake. Everything's so fake. Or you could say that if we never got off the gold standard, we would have never had an Amazon. We would have never had an iPhone. We would not have Zoom. So we'd be all sitting with our thumbs up our asses for the entire COVID, not even having a way to conduct business. And you'd miss out on this entire thing that's occurred. So there's the other side of the coin. I'm glad we have the opportunity to have a disagreement or a discussion on that, because I think that it's important not to get stuck in one way of thinking, especially if it's a way that's going to stop you from doing things.
Sure. I have many rebuttals for that, but we're not going to argue right now. Roger, what's your summary on all of that?
I think the best way to protect yourself is to be aware and have specific price levels. Like, for example, I know that if the stock market hits the 200-day moving average, I know that the long bond is going to start rallying. I don't care what it's doing. I don't care why it's doing it, but I know it's going to start rallying because it happens every time. Because traders are going to start, fleeing away from the stock market and going into fixed income because that's just how they do things. And the volatility is going to be going higher. So because I'm a short-term trader, I can react to the short-term or the long-term very, very quickly and reposition myself. So I have specific tail signs that I have put in that will alert me if something is moving out of whack. In other words, if something breaks the rhythm that we're in right now and moves into a different rhythm, my indicators and my analysis will be able to pick it up very, very quickly. And I'll be able to shift into that without having to sit there and wait for that event to happen. Because as Jeff Z said, you're going to miss a lot doing that. So I mean, you are on a long-term fundamental basis, you are 300% correct. And yeah, we are literally sitting here with our heads, in the sand. But we can be in this environment for the next 20 years. In the same environment we're in now. I mean, is it possible? Is it probable? I don't know. And it doesn't matter. And that's the beauty of what we do at Wealth Press. We could take advantage of any kind of market environment. Mm-hmm. So whether that environment is setting up or not, we will know about it just like we talked about this market selling off a month and a half, 2 months in advance. We saw all the tail signs. We were telling everybody to lower their exposure, lower their risk, get into defensive stocks, start buying basic materials, get into retail, get into residential real estate, all of the things that have happened. So we will see these things happening. And if what you're saying is going to come to fruition, it's not going to happen in one day. It's going to play out. Fundamentals take time to play out. We'll be there to catch it. And folks listening and watching us here will be able to see it coming miles away.
Mm-hmm. Okay, so should we categorize the longer term fundamental investor as a thing of the past? It's obsolete, it's inadvisable?
No, I think there's a time and a place for that. I think that investors will start looking at value when markets come off quite a bit, when PE ratio starts looking off. But we're just not there right now. Right now, we're in a momentum-based market environment. And I think that's one of the biggest struggles that Warren Buffett has had over the last several years. He has a specific way of looking at the market. The market has not fit his category. He can't find anything, and he's struggling to fit into this world we live in. And he has been underperforming the market for much of the last decade. He's missed out a lot of moves as a result of that. We're just not in that type of environment right now. We will get there again. The market will start trading below value. It'll happen. We will have a bear market again. It's happened before. It'll happen again. But why try to go 5-6 steps ahead if we only need to be 1 or 2 steps ahead right now in this environment?
You know what the irony today is that we're having this big risk off day, and one of the things that I've been looking at and pointing out on your show in particular is the dollar. You're going to see the dollar start to rally if that starts to happen. And that's why gold is under pressure today. And that's why silver's down 10% today. And that's why oil is down 4% today. And that's why base metal stocks, stocks that depend on economic growth, are getting killed today, because the dollar, who's supposed to be getting destroyed in this situation, is actually rallying.
US 30-year bond is up 1.5% today. How about that? So there you go. Yeah, it's interesting looking at the charts right now. It's like everything is having an off day except bond-related asset classes, it seems, and ETFs. So
and James, I just want to, and this, one of the reasons why I love doing this so much is because we get a chance to really speak our mind, and we each have an opinion. This is not a selling, and I'm not trying to sell right now, but to give you a real example of the power of Wealth Press strategies. So February came, last February came. It was completely unforeseeable. We obviously didn't know what was going to happen. We were not, and just to kind of, let's play that out. How do we end? We have two programs that had a built-in hedge. One of the hedge made 429%, the other one made 617%. Both programs closed the 2-week rotation up 60, 70, 80% positive, while the market was down 20%. So, and that's a built-in hedge that we currently have right now. So if something was to happen, we have our strategies are like Jeff Zinaneri has 2 stocks. He has a long and a short. If the market sold off right now, and it really sold off like a 10% move, I am positive his strategies would make money. I know that Titan and Momentum Factor and our programs most of them have a short element to it. And I know that Jeff Epstein trades to the short side as well. So we do have ways to take advantage of the unforeseeable if it does happen. Just wanted to add that because it did happen, and we didn't just survive, we prospered in that environment.
So let's leave it at that today. And gentlemen, it's been great having you and a rousing conversation as usual. And we'll talk to you then later on in the week. Have a great day.